Hi, welcome to M&A.TV. We're here with Marshall Sonenshine. He's the chairman of Sonenshine Partners, LLC. Marshall, thank you so much for joining us.
It's a pleasure. Nice to see you, Maribel.
Well, Marshall, what's the real practical significance of the U.S. debt crisis and the U.S. debt downgrade to the markets and particularly M&A activity?
Well, Maribel, I would say that it's not the ratings downgrade itself. It is the entire panoply of problems that preceded it that I think is truly significant. Look, the downgrade is a codification or ratification of what we already knew. We have too much debt in this country. We have public deficits that run too high as a percentage of GDP. And we have basic economic statistics that have run off the rails, like unemployment, which has famously gotten stuck in the low 9% range. Got a little better last month. It's not all bad news, by the way, but the overall news cycle has not been good. We know that. The real significance is that we have a fragile economy and a very, very slow U-shaped recovery. And like most things in human development, recovery doesn't happen in a straight line upwards. We don't grow that way. We don't learn that way. We take 2 steps back and a step forward and a step back, and we zigzag our way through. But this is a long, slow process. And this downgrade and the effect that it has had on market sentiment and confidence is simply a yet another expression of that overall problem that we really have had for some years now.
Well, put that into context in terms of M&A activity.
Well, M&A is fussy stuff. M&A is fragile. A lot of things go into making deals happen or not happen. And M&A likes a calm, friendly environment in which buyers and sellers can agree on price, and buyers can finance deals, and sellers like it when buyers will even compete for deals and drive prices high. Right now, the environment is anything but friendly. It is very, very fragmented. That's not necessarily good for M&A, although you also do see in this marketplace opportunistic buying. So even last week, in the middle of the great debacle that was the U.S. debt crisis last week, and it wasn't successfully resolved. We got through the debt ceiling issue by the skin of our teeth, as we all kind of knew we would. Those of us who negotiate for a living could see this thing was heading towards a last-minute deal from the beginning. That said, in the middle of all that, Blackstone spends $3 billion to buy Endemol, which was a healthcare information services and processing business. Li Ka-shing from Hong Kong, essentially a financial buyer, spends $4 billion to buy a public water utility business in the United Kingdom. Wilbur Ross and CIC spent $1 billion to buy tankers that transport energy. So this is last week, in the middle of the cycle. So it's not as though M&A dries up altogether. If anything, you start to see a flooring take place sometimes. And if the situation got bad enough, the flooring will not be there either. If there's no financing, there ain't no flooring. But for the moment, I think there is a floor. I think this market snapped back fairly quickly yesterday and popped back over 11,000, thankfully. So there is a flooring going on in public equities and M&A provides that function. It does require enough conviction, enough clarity for buyers to plunk down their money and sellers to feel that they're not selling in distressed conditions.
Now, you just talked about opportunistic buys. Are there particular sectors or industries that are attractive for the second half of the year?
Well, I think the things that are most attractive right now, given the macroeconomic and global forces that we're all contending with, are energy, which is a great hedge against inflation, and we are seeing, whether it's Progress Energy or lots of other deals that have been taking place this year, the Chinese just spent a couple of $1 billion buying energy assets in North America. We're going to continue to see that. Infrastructure, tremendously important. We know that in this country we haven't yet seen a Works Progress Administration type stimulus package, but it's only a matter of time before we will. We need it. We have bridges falling down, highways that are in disrepair. We lack high-speed infrastructure that we need. Anybody who spent any time looking at the financials at Amtrak or sitting on Amtrak will probably agree that we would do a little better on consumer transport in the railroad sector. We have lots of work that still has to be taking place in the nation's airports in response to security concerns and traffic concerns. It's been a nightmare, and it does slow down the economy. So we need that investment. So infrastructure, I would say, is a good play. Utilities are a good play. They prove to be very enduring because they are regulated entities, and people still need power, even if they don't have as much extra money for discretionary spending. They still need the power, and utilities pay dividends. If you can get 2% yield on a stock right now, that means that you're getting the same yield you could get on a 10-year treasury, but you also have upside in the stock. So utilities will continue to be interesting as a stock, but I think also as part of this macroeconomic change. I think that the reason we're seeing some retail deals on the side is mostly opportunistic. When TPG was buying J. Crew earlier this year, or Bain and a few other private equity firms put together money to buy BJ wholesales. They were really buying retailers in a stuck market where you just were not seeing the top line growth, you were not seeing the margin, and there was an opportunity to buy quality companies at good prices. We may see some improvement there too, and some broader M&A activity in retailing, in part because separate from this news cycle, we were seeing a little bit of improvement. The same-store sales by consumers in this country last month were up 4% and change. That's not so bad. So I think that it's a mixed picture for different reasons, but I would start with that first three categories as the fundamentals that are really opportunistic right now given the macro forces. And I would say as we make improvements, God willing, if we start to see the unemployment figures come down and the consumer have a little bit more liquidity, won't happen immediately, but longer term, I think we're starting to see a little bit of that come into acquisition of retailers and consumer businesses as well. And that's a good thing. I hope it will continue. I think right now we're at a moment of fragility on that subject, but I think it's in the mix.
Marshall, what about cross-border activity?
Well, cross-border continues to be probably one of the most interesting and dynamic parts of the global M&A business. Even in a weak economy, even from one of the most troubled economies in the world, which is Japan. It's really in the 20th year of a long recession that seems to never really end. Kirin Beer just spent $2 billion to buy a Brazilian beer manufacturer, and we've seen a fair amount of consolidation more broadly cross-border in the beer industry in Australia and in Asia. China has been a very strong buyer of businesses. Going the other way, we represented last year Alcoa selling assets to China that were based in China that Alcoa itself no longer needed. We also sold some assets for Alcoa in Europe that it no longer needed and that a European group bought. You're seeing a lot of fluctuation in capital flows, in manufacturing activity, and in foreign exchange, and this affects people's perceptions of what markets they really want to be in, what are they willing to sell, even in a distressed market, which we were absolutely in for manufacturing over the last couple of years. And then, too, you also have the problems of building scale to be competitive in financial markets. So, for example, another deal that we did not too long ago, speaking about last year at the moment, is Genesis AirCap, which was the largest merger in the air finance industry. It was about a $5 billion deal in terms of total value of aircraft that were in the two portfolios that we put together. What was that really all about? It was about becoming a stronger, potent force in a marketplace that just needs that, a certain degree of scale to take out extra costs, offer a broader portfolio of assets to airlines that themselves aren't shifting sands. When you get this amount of change, you need to have a certain amount of blocking power and defensive power. So financial driven, and that was a cross-border deal too. I think we're going to continue to see all of that. The question is, how much slowdown will we see based on a lack of conviction? I was glad to see a little bit of that flooring that I referred to earlier in the stock market yesterday, where we saw a snapback. I think as those pieces come into place, we'll continue to see international be a very important part of the M&A landscape.
Marshall, what about the fact that these U.S. corporations and private equity firms are carrying a lot of cash on the books? What impact does that have?
Well, fundamentally, it's a good thing to have liquidity in a world that has just gone through the greatest liquidity crisis in the history of modern finance. So having cash is a good thing. I think the estimates that I see is that total aggregate cash on the balance sheets of U.S. corporations right now is about $1.5 trillion, maybe a little bit more. And total amount of capital, by the way, on call by private equity firms in the industry writ large is about $500 billion. That's a lot of money. They've been sitting on it a long time, by the way. On the one hand, it gives buyers some comfort that they have the cash component of an acquisition, or in theory, all of the acquisition cost at their disposal. If things get opportunistic enough, they can snap their fingers, write the check, and be done. In reality, most buyers, certainly on the private equity side, but even to some extent on the corporate side, are unwilling to or don't desire doing all cash acquisitions if they can't finance themselves. Because if they can't finance themselves, even if they have the cash, they become hoarders of cash, and they see that inability to finance themselves. If their banks are not lending money, it's going to dampen their enthusiasm. And what's going to happen, human beings being the way we are, they'll start to take that into account as one of the cues that gets them to write lower projections, and little by little they're going to start to drop the price, and before you know it, the seller is going to say, you know what, I don't need this, or they're not even going to get that far. They're going to say, look, if we have to do this in all cash, maybe this is not the greatest moment in time to do it. I think corporations are a little bit more willing to use their cash than private equity firms on a 100% cash basis. We have not seen private equity firms do that. It does have flooring protection. It enables buyers to act when the opportunity is there, but I think buyers like to see a functioning capital markets, whether they're needing it or using it for that transaction or not.
Do you think the debt downgrade has impacted valuations when you're working a deal?
The debt downgrade is a statement of truth. I think that if the position of S&P and Moody's and Fitch, which I hasten to add have not downgraded, and I hope they don't, but if the position where you can add all the debt you want to the balance sheet, we don't care, you'll always be AAA, I think they would lose a little bit of credibility. And I think truth has its own sanitizing effect on the psychology of marketplaces. I think it's not the downgrade itself, as I said earlier. I think it is the things that inspired the downgrade that were the catalyst for the downgrade, and the lack of confidence in both the creditworthiness of U.S. public financial, the U.S. public financial situation, and the lack of confidence in Washington's ability to manage the economy right now. That will have a dampening effect. You still will see some opportunistic buyers coming in, and as long as we have that flooring effect that I spoke of, I think we'll be okay. We may be a little bit of a smaller M&A market, but we'll be okay. But that troubles me, and I think it will continue to trouble all of us who are doing business in the financial markets right now.
What does Wall Street want from Washington?
What Wall Street wants is less of Washington in its life, and it's almost a talismanic knee-jerk reaction. Give us less regulation. You come out with Dodd-Frank, we'll tell you why it's not a good idea, or we'll go into our lobbying perspective on the rulemaking procedure, and we'll try to dilute it even more. The truth is, that's not really, in my judgment, in Wall Street's interest. It's just that Wall Street acts as if it's in its interest. Most people in Wall Street individually are myopic. They say, as an institution, we'd like the ability to make our own judgments about how we're going to operate in the derivatives market or in the foreign exchange market or in the leverage finance market. If we want to create off-balance sheet entities, we'll do it. We'll deal with our ratings issues. Thank you very much. Leave us alone. And then they get in trouble. And when they get in trouble, then they want more of Washington in a hurry. It's called bailout. And we just went through that cycle, and it bred a certain level of cynicism. I think the truth is that what Wall Street should want is intelligent regulation, intelligently organized markets in which regulation is helpful, not wasteful. The truth is Washington doesn't necessarily know how to deliver that all the time. Wall Street knows that, and so the dance becomes more a dance about Washington, at least on the Democratic side, pushing for progressive change and reform, and Wall Street on the self-interested side resisting it. If we could somehow get past all that and come up with intelligent reform, I think everybody would be better off. I think Dodd-Frank is a step in that direction, but it's a step in what is probably a very long-term odyssey, not a quick fix.
Talk a little bit about what other financial issues or drivers you see for M&A activity for the remainder of the year. What are you looking at?
Well, one of the most important drivers of growth in the first half of the year was strategic. We've seen a lot of important M&A that was strategically driven, whether at the very, very high end of the market, like AT&T, T-Mobile, and that was obviously a very, very strategic statement, or Microsoft buying Skype, or Duke Power Progress Energy, lots of those deals where you're seeing very, very large corporations coming together to create a much stronger, formidable bloc with global and financial powers to compete effectively in a very, very difficult geopolitical environment. And that's a good thing. By the way, just last week I read that in Japan, which again has been a troubled economy for 20 years, Hitachi and Mitsubishi are talking about putting businesses together. That would have been unheard of a generation ago. Now it may be a form of saving themselves from themselves because they got real problems in that country, more than any country should have to endure, and they've had natural and unnatural disasters on top of a 20-year recession. We see that continuing. I mentioned drugstore.com, which we represented and sold to Walgreens. That was a very important strategic move for Walgreens on the retail meets e-tail front. Another example in our practice, we represented Lavazza, which is one of the largest coffee roasters in the world, actually the largest in Europe, family-controlled business, very substantial business that never had made an acquisition or made a substantial investment overseas in the M&A transactional sense. And we put $250 million of that company's money into Green Mountain Coffee, at a discount to the market, by the way. We got them a 20% discount, which is unheard of for a pipe. This was a mega pipe deal. And we also got them global distribution rights to the single-serve market, which Green Mountain is absolutely the lead player in. Wow, what an effect that has had on our client's company. By the way, the stock in Green Mountain has tripled. So on $250 million of investment, they've made one hell of a whopper profit. But alongside that, they got global distribution into a market in which single-serve is kind of everything right now. We see that consistently. We just did another deal representing the last remaining independent chain of hearing aid stores, Audiology, and it was a company whose stock had traded on extreme weakness. It was next to nothing. We put it through a Chapter 11 procedure and did a 363 competitive auction with a very high stalking horse bid and got Siemens and one of its competitors to bid against each other, and the thing went for a huge price. We did the same thing, by the way, not long ago in another chapter case, Philadelphia Inquirer or Philadelphia News, where we litigated the right on behalf of the debtor to require all bidders, even if they were creditors, even if they were pre-petition creditors, to bid cash, no credit bidding. Unheard of. I got the "you'll never eat lunch in this town again" calls all the time from the hedge funds, and I used to say to them, "Oh, we're just following the U.S. Bankruptcy Code, which permits this." And last I checked, that's an even higher authority, U.S. Congress, than the hedge fund community. But be that as it may, they all had to come with cash, and they bid against each other. And they bid against the local family. And before you knew it, we had a damn good auction, and we sold the newspapers for $135 million, constituting the highest price that anybody has seen for an American newspaper group since this wave of restructuring began. Sometimes strategic or financial impetus can actually lead in the M&A market to very good results. We consistently see that. A lot of it, I think, is strategic in this market, but it's been on both sides of the equation.
Marshall, in terms of M&A activity, what's everybody focused on right now?
Well, I think the most intelligent voices in the merger and acquisition community are about competitiveness. We are living in the most uncertain times. Markets are fragile, markets are fragmented, geopolitical risk is running high, passions are running high. We have riots going on in London right now as we sit here very calmly on Park Avenue in Manhattan. We've seen Greece go into such tailspin and require so much support from within the European community that there's now a question mark about even the German AAA rating. Now, I don't know whether that'll get downgraded too, but there's social costs and social effects to all this, and there's a certain fragility in the world today. I think what people most need today is competitiveness. Competitiveness means the ability to navigate best products and services at lowest costs to somebody on a basis that you can finance it predictably and well. That's not easy, but I think that's driving, on the strategic side of the ledger, that's absolutely driving it. For private equity sponsor-driven deals, I think strategy is also really important. We're seeing more and more activity within portfolio companies looking for ways to shore up portfolio companies through add-on acquisitions or through capital markets transactions. And I also think that the days are kind of over where merely buying a company and warehousing it for a few years is going to be a winning strategy for private equity firms. They need to buy companies and be good stewards of those companies in a competitiveness sense. There's a lot of lip service in the private equity industry to being partners to management and to adding value, and a lot of that some of it was true, but a lot of it in many funds cases was more lip service, and their results show it, because most of the industry didn't really outperform the public equity markets at all, and it's not clear why an industry that doesn't outperform the public equity markets but requires illiquidity and greater leverage and greater concentration from its investors is adding value. I think competitiveness right now is the watchword. I think the best of breed firms are getting more and more operating partners into the mix, onto their operating committees, investment committees, looking at businesses from the perspective, what can I do to make this better while I own it, as opposed to simply, how can I get it and hope I can make a profit by selling it sometime down the road. It is not a kick the can down the road business anymore. It is now how do I make a business better, stronger, faster, more competitive in a very, very difficult environment for both strategic and financial buyers.
Do you think that we're heading into a double-dip recession?
Well, it's sort of it's an interesting question. One could argue it's an esoteric question, because I'm not sure that we ever really came out of the first recession. Look, we are in one of the longest U-shaped, and actually Joe Stiglitz said last week, L-shaped, not even U-shaped. He's saying we're just going like this right now. We don't really see the other half of the recovery periods that we have seen in modern financial history. This is a very, very sticky, sluggish, slow recovery, if ever there was one. We're still at 9.1%. We can celebrate that we added 117,000 jobs last month, or got 4.6% comp store sales increases in the retail sector, or had some good news on the manufacturing side. We had a lot of non-farm payroll jobs that were added on manufacturing. That's not so bad. But the reality is, this is a slow recovery. Is it double dip, or is it simply the same old, same old? I think we're muddling along. And I think from the very beginning of the 2008 financial crisis, what you heard is absolutely true. Sometimes the truth is out there and everybody sees it and knows it. This is going to be a jobless recovery. That's true. This is going to be a U-shaped recovery. That's true. Those headlines, in my mind, matter a lot more than the somewhat esoteric debate about whether we're going to see the double dip. I hope it doesn't get worse. My real expectation is we're going to kind of muddle along, and I think the big wild card is, will there be shocks to the system from the geopolitical side? I hope not.
How are we going to do for the second half of the year in terms of M&A activity?
Well, as I said earlier, if it weren't for this really nightmarish mishandling, really mangling of the public debt crisis in Washington, I would have said we look pretty good at $750 billion per quarter, $3 trillion overall global M&A. I think we'll see some softening. God willing, it'll be a little bit of softening, not worse. We won't see the greatest financial or geopolitical shocks to our marketplace. and we'll be able to continue doing business in an orderly way. We do have a good leverage loan calendar. We have a good loan syndication calendar. The CLOs are back in business, and when they are properly structured and properly regulated, they are not a bad thing. They create a liquidity exit for the lending community, which I think is very, very important. The high yield market has continued to be a very strong provider. By the way, at very attractive rates. I mean, if Chrysler can come to market, as it did a few months ago, and borrow money at 8%, that's not so bad. And by the way, all three of the big three had very strong big three automotive manufacturers in this country, had very good automotive sales in the last quarter. It's not so bad. So we have capital markets that are functioning. The IPO window has been amazing, and we've had, I think, overheated IPOs in the social media side, whether it's LinkedIn or Facebook or whatever. A lot of activity in that sector that, if anything, you could say that's sort of vaguely reminiscent of bubble period activity. It's not so bad. We can get through this, but we really do need to see better stewardship in Washington. That's the one part of the equation that we can control. What goes on in terms of violence or discordance or real shocks to our financial system in other countries, we can't really control that. We can respond to it, and we will, and we have to. But what goes on in our marketplace, we can do better, and I hope we do.
Thank you so much for joining us. We're going to leave it there. Thank you, Marshall.
It's a pleasure.